How much should you invest to live completely off dividends? I will show you the numbers, but I've also got to warn you. Most Europeans get dividend investing completely wrong, and that costs them a lot of money. Hi, I'm Tom Crosshill. Over my 18 years in finance, both on Wall Street and as a pension fund CEO here in Europe, I've invested hundreds of millions of euros into the stock market. In this video, I will show you how much income dividends can give you today, the most common dividend investing mistakes, and how I personally take passive income from my portfolio. Alright, but first things first, just how important are dividends to stock investors? Well, take a look at the S&P 500. So this is an index of the 500 biggest American companies. If you bought the S&P 500 back in 1976 and kept your money invested until today, your total return would have been an average of 11.7% per year. This means that $1,000 invested would have become $254,000 by today, which is tremendous. Now, this 11.7%, it includes both stock prices going up and dividends. If you remove the dividends, your average profit would have been just 8.8% per year. And this would have made a massive difference. If you got zero dividends over the past 50 years, then $1,000 invested would not have become $254,000. It would only have become $69,000. So clearly, dividends are very important for stock investors. But what are the numbers like today? Assuming that you want 50,000 euros in dividend income per year, how much money do you need to invest to get that? Let's look at some real-life dividend yields based on 3 common stock investing strategies. Now, in this video, instead of picking individual stocks, I will assume that we're buying stock ETFs. These are investment funds that invest in hundreds of different stocks at a time. Okay, so the first strategy we're going to look at is broad market investing. You buy an ETF which invests in hundreds of different companies in different industries. We already looked at one broad market index, the S&P 500. So let's check out an ETF that tracks this index. Specifically, let's look at the Vanguard S&P 500 UCITS ETF distributing. We're looking at the distributing version because we're interested in income, and distributing ETFs pay out dividends. So this ETF has around 500 holdings, the biggest companies in America, and it has an expense ratio of 0.07% per year. So that's how much it costs us to use this investment, which is great. Now, how has this investment performed? If we look at the total return, so this combines both increasing stock prices and dividends, then over the past 5 years, this fund would have earned us 92.5%. That's around 14% per year on average. That's a fantastic result. But the question is, how much of this came from dividends? Well, to find that out, let's scroll down to the dividend section. And we see that the current dividend yield is 0.98%, so roughly 1% per year. This means that pretty much all of your profit with this fund comes from rising stock prices, not from dividends. With a 1% dividend yield, you would need to invest as much as 5 million euros just to get 50,000 euros per year in dividends. I mean, that's ridiculous, right? I mean, with 5 million euros, you could buy a bunch of rental apartments and get much more passive income. Now, there are reasons why a broad market ETF like this one pays very little dividends these days, and those same reasons will lead us to a better way to take passive income from stock ETFs. I'll explain that later in the video. But for now, let's look at a second strategy: investing in stocks that pay above average dividends. A number of historical studies like this one have found that stocks which pay higher dividends do tend to outperform the broader market. And today, there are many ETFs which target these types of stocks. To start with, let's stick to the American market. Let's go to justetf.com, which is a great database for finding ETFs that are available to European investors. And we can look at ETFs that invest in American dividend stocks. The biggest ETF here is the SPDR S&P US Dividend Aristocrats UCITS ETF. If we open this one up, we see that it invests in 149 different stocks, and the Dividend Aristocrats Index tracks stocks which have increased dividends every year for at least 20 consecutive years. So that sounds pretty nice, right? But if we look at the dividends section, we see that the current dividend yield for this fund is just 2%, which doesn't seem like that much for dividend-heavy stocks. At 2% per year, it would still take 2.5 million invested to generate 50,000 in annual dividends, which is not a very efficient way to take passive income from your portfolio. In fact, this seems to be an issue with these American dividend funds. If we look at the 5 biggest funds here, I mean, the highest dividend yield we see is here for the Wisdom Tree US Equity Income ETF, which is 2.7%. Better, but nothing to write home about. The situation gets a little bit better if we look globally instead of just focusing on America. So let me remove the United States filter, and we have a bunch of other dividend-heavy ETFs to look at. The biggest one is the Vanguard FTSE All World High Dividend Yield UCITS ETF distributing. And this one is actually pretty interesting. So it's got over 2,000 different holdings, so it's very diversified. The costs at 0.29% are reasonable, and the performance has been pretty great. So the 5-year performance has been a respectable 83.5%. And the current dividend yield, well, it's not absolutely fantastic, but it's 2.6%. So running some back of the envelope math, if I need 50,000 euros in dividend income at 2.6% per year, that means I need to invest around 1.9 million euros. So somebody who's looking for a diversified, low-cost dividend strategy might like this kind of fund. Among the other 5 biggest funds, we also see this Van Eck fund, which has had a tremendous 5-year result of 142%. But if we open this fund up, we see that it only has 100 holdings. It's a lot less diversified. So in this kind of situation, I would be concerned that maybe past performance is not the best indicator of the future. Just because it had great results over the past 5 years, it might not have similar results going forward. But at least with this second strategy, we're getting somewhere. When you buy dividend ETFs, you target high dividend paying stocks, which give us some more passive income, not a tremendous amount, but more. And historically, these kinds of stocks have performed quite well. So it's a decent investment strategy. There are a few major downsides with this strategy that I'll explain in a minute. But now let's look at the third strategy, which is simply look for the stock ETFs that pay the highest dividends. So let's say I take this same list on justetf.com, but I sort it by this column, by the dividend yield, and I just look at the ETFs that are paying the highest yields. Well, I see some amazing numbers like 8.8% per year, 7.9% per year, 6.2% per year. Now, that's some real dividend yield, right? If I'm getting 8.8% per year, how much do I need to generate 50,000 euros? That's just 568,000 euros invested. Much nicer, right? So where's the catch? Well, there are 2 catches actually. To explain the first catch, let's look at one of these funds, the iShares Stocks Europe Select Dividend 30 UCITS ETF. When I open up this ETF, which has a high dividend yield, I notice that it has only 30 holdings. So it's not very diversified. If some of these stocks run into trouble, I run into trouble. And then if I go to the holdings section, I will see that around half of the portfolio, 49%, is invested in financial stocks. The last few years have been tremendously profitable for European banking stocks, so that is why this ETF has done great. But if the financial sector hits any trouble, it could suffer. So the first catch is that really high dividend ETFs are often, not always, but often, poorly diversified, and they can be quite risky. And to explain the second catch, remember that with stock investing, we care about the total return. So that's dividends plus price changes. And unfortunately, when you find companies with very exceptional dividend yields, really high numbers, well, that often means that there's a problem on the price side of the equation. I mean, just think about it. If a stock has a huge dividend yield, that means the price of the stock is low compared to all the dividends the company is paying. And if a stock price is low, why is that? Is it because investors are idiots and they're not buying it? Well, usually no. Usually there's a reason that investors avoid this stock. It could be a dividend trap, a stock which pays tons of dividends, but the price keeps crashing and crashing. So in many cases, the total return you end up getting is not so great. For example, the ETF with the highest dividend yield in our list, the Global X Super Dividend UCITS ETF, had a 3-year total return of just 29%, while the past 3 years have been tremendously profitable, much more profitable for the global stock market. Here's the brutal truth. It is very hard to build a smart, diversified portfolio that pays a high dividend yield. If you want to live completely off dividends and get a great investment result at the same time, that is difficult. But here's the good news. That is not necessary because dividends are not the only way to get passive income from your portfolio. In fact, there are several important reasons why relying on dividends for your passive income could be an expensive mistake. Well, we already covered the first two reasons. One, a high dividend portfolio can often be poorly diversified. And two, a high dividend yield is not the same as a high total return. To explain the third reason, let me ask you this. Who do you want to decide how much money you're going to spend on rent, food, travel, and your kids' birthday presents next year? Should it be you? Or should it be a bunch of men and women in suits sitting around boardroom tables? If you tie your passive income to dividends, you lose control of your spending level. Your income depends on what company management decides to pay out. It is no way to do financial planning. Now, the fourth reason dividend investing is suboptimal is, of course, taxes. In most European countries, every time a dividend hits your account, you get taxed on it. Now, if you're confident that you will spend all the dividends that you get, it doesn't really matter. But if you might want to take some of those dividends and reinvest them, this becomes very tax inefficient. The next reason is little known. Most amateur investors have no idea about this, but it explains why the S&P 500 pays such a low dividend yield today. It's not just because American stock prices are high. It is because over the years, more and more profitable companies have decided to use their profits for share buybacks instead of dividends. In a share buyback, the company goes into the market and buys back its own shares from investors. It's basically a different way of putting money back into investors' pockets, which also drives up the share price at the same time. And actually, the topic of profitability leads me to the next reason why dividend investing is not my favorite these days. So when you look at the data, profitability is a much clearer indicator of a good stock to invest in than dividend policy. In fact, there are two factors which largely explain why dividend-paying stocks tend to perform well. One is that dividend-paying stocks tend to be profitable, and the other is that dividend-paying stocks tend to be value stocks, meaning that the stock price tends to be relatively cheap compared to financial fundamentals. But if you take dividend stocks and you compare them with other companies which are equally profitable and also priced reasonably, but which don't pay dividends, there is no real difference in expected returns. So this is my sixth reason for being skeptical of dividend investing. Dividends are simply not the right criterion to focus on. Investors might be better off looking at strategies like value ETFs or quality ETFs, which target reasonably priced or profitable companies instead. And then there's one more major reason to be skeptical of dividend investing. Companies and fund managers tend to manipulate dividend investors. Everybody knows that investors have this irrational bias, this preference for dividends. So companies will take advantage of that. In some cases, struggling companies will do anything they can, like selling off assets or cutting costs beyond what is reasonable, just so they can pay out some dividends and get you to buy the stock, which then goes ahead to perform poorly. Even more dangerously, financial institutions also know about this bias. ETF providers will create exotic products like so-called covered call ETFs, which pay really incredible dividend yields like 9 or 10 or even 11% per year. And investors will fall for these products, forgetting that in finance there is no such thing as a free lunch, and their long-term results will be much worse than if they simply invested in a broad market ETF. So there's lots of reasons to be skeptical of dividends. But if dividends are not the best answer for getting passive income, what is? Well, to understand the solution, we have to dismantle a dividend investing myth. Here it is. If you only take dividends from your investment, that means you are not touching your capital, and that's a safer way to invest. Okay, let me be 100% clear. This is an illusion. Every time you get dividends from a company, you are touching your capital. A dividend is just money that used to be in the company's pocket, so it was part of your capital because you're a company owner, and this money is now out of the company's pocket and put into your pocket. And the moment the dividend leaves the company's stock price drops to reflect that your capital has departed. There is no reason, zero, to think that getting a dividend touches your capital less than selling a bit of your stock position. Once you accept this, you can put emotion aside and become more neutral toward how you get your passive income, whether it's through dividends or selling stocks. In fact, as a practical matter, selling is much more convenient because you can choose exactly how much income you need and when you need to get it. In most European countries, the most elegant way to take passive income from your portfolio is to invest in so-called accumulating ETFs, which never pay dividends at all. And then you simply make a withdrawal plan, like you want X thousand euros per quarter, and you sell the corresponding amount of ETF shares. And this allows you to control the timing of your money and to only pay tax when you absolutely need to. Now, in some European countries, accumulating ETFs don't have this tax shielding benefit. For example, in Austria or Switzerland or the UK, you have to pay tax on dividends that sit inside an accumulating fund, even if you don't get any cash. So in that case, you might also use distributing ETFs, get the dividends when they come, and then top up that amount by selling as much or as little as you need. Either way, you can control exactly how much money you get and when. Now, if you live in Europe and you want to start investing in ETFs, whether it's to build your wealth or to get passive income, you will typically face a lot of questions like which ETFs are the best to choose, and how do I handle taxes? What brokerage is the most reliable? And how do I take out passive income? In this YouTube channel, I cover these questions one at a time. But if you'd like a step-by-step training that gives you all the knowledge that you need in a simple, organized way, and if you'd like me to be there to answer all your questions, then check out the Index Masterclass, my training program for European investors. Just follow the first link in the description to find out more.